Hello and welcome to this episode of Mic'd Up. I'm Pete Seiler, part of our business development team here at iCM. And today I'm joined by Brent Ledbetter from Research Affiliates. Brent, thanks for joining me.
Thanks so much for having me.
Absolutely. So let's jump in. It's certainly been real strong start to the year for emerging markets equities. Can you talk about a few of the key drivers for EM performance so far year to date?
Oh, of course. It's been a bit of a bifurcated market in emerging markets, right? This is the EM is really a heterogeneous group of countries that are all thrown together, despite the fact that they, in many cases, aren't terribly similar, right? There aren't a lot of points of commonality between markets in Brazil and markets in Taiwan and Korea, for example. So as a result, that bifurcation has really led to a pretty steep dispersion year to date, where a decent size of the returns have been coming from, or a decent portion of the returns have been coming primarily from Korea and Taiwan. And then if you narrow that down even more specifically beyond just Korea and Taiwan broadly, you're really talking about just a few companies. It's AI related names from the chip side, where you've got Samsung and SK Hynix driving returns in Korea, and Taiwan Semiconductor driving returns in Taiwan.
All right. So how has this really impacted the overall valuation landscape for the asset class, if it has at all?
Sure. So overall, EM remains reasonably priced on a Shiller-Cape basis, which is current price divided by 10-year smooth earnings. EM's still below 25, which is not exceptionally cheap, but when you compare it to the US that's north of 40, it does look attractively priced. That said, that's EM broadly. Within emerging markets, if you look at, again, those areas that have done really well, Korea, as an example, on a 12-month basis through the end of June, Korea was up 215%. If you extend that further and look at an 18-month basis, Korea was up another 40% in the first 6 months of 2025. So on an 18-month basis, you're looking at north of a 300% return, which means that it's quadrupled. So as a result, Korean companies are expensive. Taiwan's expensive as well. On a Shiller-Cape basis, again, our preferred metric, because it removes cyclicality from the denominator. Just for a point of reference, the US peaked in March of 2000 at 44 times. 44 times trailing 10-year smooth earnings. Korea today is at 45 times, and Taiwan's at 52. So while the broader index is at 25, you've got a couple of outliers that are pushing it quite a bit higher in Korea and Taiwan that quite literally, by a Shiller-Cape basis, are more expensive than the US was at the peak of the bubble.
So, I mean, if I'm hearing you correctly, this is really coalescing around some concerns for Korea.
Yes. Concerns, not necessarily concerns with regard to the businesses themselves. I don't have a view on the health of SK Hynix or Samsung, but concerns on the valuations. And I think this is a case of perhaps it's worth considering investments beyond just the underlying story and narrative that's driving the stock. And I think it's worth considering whether or not the valuation is warranted, even when considering the narrative, right? What sort of growth assumptions need to occur for a 52 times Shiller PE to be reasonable? And they're very, you need to do some mental gymnastics to come up with the growth assumptions required to get to a present value today that warrants that sort of multiple.
Absolutely. So this dovetails really into my next question. Do you have any concerns around, concentration risk in the broad MSCI index?
Very much so. Again, I'll use the US as a point of reference. There's been a lot of talk recently about the Mag 7 and some of the memory companies like Micron. Lots of concentration in the US, and a lot of it's AI driven. That's not a purely US phenomenon. This is something that's impacting markets outside of the U.S. And EM is in some ways more concentrated than the U.S. is. If you look at the MSCI EM index, Taiwan Semi, one company alone is more than 15% of the index.
Wow.
That's followed closely by Samsung's at about 7%, and SK Hynix is nearly 6%. So you've got between 25 and 30% of the entire index focused in just three firms, which I think might be a little bit surprising for some investors, because I think one of the driving reasons, at least one of the driving reasons that I've used indices historically, is for one-stop diversification. Right,
Sure.
your assumption is when you're investing across multiple hundreds of companies in a broad basket in an index like solution, you're likely going to get a pretty decent diversification. When you reach a point where you've got nearly 30% of your portfolio in just three companies, there's a chance that the average EM investor is not getting the level of diversification that he or she assumes that they're getting.
So it sounds like you're really making a case for active and selective management in the asset class.
Yes, either active or a non-price approach to passive. I would favor. I'm obviously very biased, given that we offer
Sure.
RAFI indices that select and weight companies by fundamental measures of size. But you don't have to use RAFI specifically. Some measure that breaks the link between price and weight will give you a more diversified portfolio than what the benchmark's giving today. And there's also very much the potential that you can find an active manager who's substantially less concentrated than the benchmark is, which again is odd, because normally it's the other way around. Normally you're looking at an index as a more
Yeah.
diversified solution relative to an active manager. Today, those roles are almost can't, depending on the manager, those roles may actually be reversed.
Great. So with the cautionary tales out of the way, let's talk and transition a little bit to areas of opportunity that you see overall in emerging markets.
Sure, sure. EM's had a pretty steep transition over the last handful of years. When we were in the depths of COVID, late August, early September 2020, China peaked at around 42% of the EM index. At the time, I was getting a lot of questions from institutions asking us to build EM ex China indices for them, specifically because they wanted to go out and hire dedicated China A shares managers. They wanted more exposure to China. They wanted to be overweight relative to a cap-weighted benchmark that had more than 40% in China. China has subsequently performed rather poorly since. What's interesting to me is part of the reason China's performed poorly is concerns about geopolitical risk. And I say it's interesting because the concerns around geopolitical risk are perhaps most vividly captured in concerns around the potential for some sort of Chinese action with regard to Taiwan.
Okay.
And which is odd, because as a result, Chinese companies on the whole are relatively inexpensive, yet Taiwan's not being negatively impacted from a valuation perspective at all. So it's strange to me that investors are concerned with regard to China from a geopolitical standpoint, but seemingly have no concerns with regard to Taiwan, despite the fact that in this case, it seems that the two are inextricably linked. If there's a, if their conflict occurs, they're both going to be involved, unfortunately.
Sure.
Um, Beyond China, other areas that are cheaper still, Brazil. You can get exposure to Brazilian equities for. I'll keep coming back to our favorite ratio, Shiller Cape. You can get exposure to Brazil for less than 10 times. So current price is less than 10 times 10-year average earnings for a reasonably large economy that has a lot of exposure to the areas that will benefit if there's an uptick in geopolitical tension, right? The Brazilian companies, Brazil as a whole has a pretty large exposure to energy, to oil, to metals. They have some of the largest food producers. So Brazil is a reasonably large economy, And to be able to get exposure to a reasonably large economy for less than 10 times trailing 10-year earnings looks really attractive. And this is where, it comes down to should, is it, can you make a reasonable argument that Taiwanese or Korean names should trade at a premium to Brazilian names, given that they're in more growth-oriented industries? Sure, I think that's a reasonable argument. Should the premium be 4x or 4.5x or 5x? That's where I start to question whether or not the dispersion in multiples is really warranted. It feels like the premium that investors are paying for Korean and Taiwan names is rather steep. And frankly, you don't have to go back that far to find a time when Korea wasn't trading at a steep premium. I mean, it was just it was December of 2024 when the Korean president briefly imposed martial law that worked out very poorly, hence why he's the former president. And at that time, Korea was trading around, it was between 10 and 15. It was around 12 times trailing earnings. It was only a little bit more expensive than Brazil. Since then, the AI story has taken off, and SK Hynix and Samsung have soared as a result. So I share this because it's not a given that Korea should always trade at a massive premium to Brazil, China, some of the other cheaper emerging markets countries.
Got it. And as we bring our conversation to a close, any thoughts around EM currencies?
In terms of EM currencies, specifically relative to the dollar, many of them look reasonably attractive. Particularly, Brazil stands out as one that's cheap. But what we saw last year was a little bit of weakening of the dollar and a tailwind for emerging markets currencies. That's reversed, albeit modestly, this year. What I would note is, despite the fact that we're contrarian, we still like non-dollar currencies despite the dollar's weakness last year. And the reason for that is because 1 year worth of weakness for the dollar does not undo 15 years of strength. So the dollar remains quite a bit closer to its high than it is to its low. We think non-dollar currencies look attractive. Many of the EM currencies in particular look cheap relative to the dollar. And I should be explicit both with regard to currencies and with regard to equities, noting that attractive valuations are suggestive of longer term potential for excess returns. This isn't to suggest that mean reversion necessarily occurs on a very short-term basis.
Absolutely.
Right? Back to the equities, Korea and Taiwan can certainly get more expensive still later this year. Brazil can get cheaper still. But if I had a 5 to 10 year time horizon, I would very much favor Brazil and China versus Korea and Taiwan. And same thing with currencies. I'm not going to pretend to know what's going to happen with currency prices over the next quarter. But if I had a longer term horizon, if I'm a long-term investor, particularly if I'm a US-based investor and the bulk of my portfolio is denominated in dollars, I would likely be looking for some non-dollar diversification, given the fact that the US dollar remains relatively strong relative to currencies in the rest of the world.
Brent, this has been great. I want to thank you for joining me today.
Thank you so much, Peter. This is a lot of fun.
Absolutely. And for our viewers, thanks for taking the time to watch this video. And if you enjoyed it, please like it, share it with your colleagues, and don't forget to subscribe to our YouTube channel to receive notifications of new content when it hits the channel. Thanks for watching.